one here, we have this graphic where you have a period of trading. Let's say this is a day of trading. So we have the open of the day, and here we have the close of the day. So the day opens and price moves up and it moves down, and it moves up and it moves down. And contrary to much belief, people think that price is moving higher and it's moving lower as a result of buying and selling. And while that is partially correct, it's not entirely correct, because price is moving higher and it's moving lower because price is looking for liquidity. And so without unfilled orders in the market, price would not move. If we have a bunch of sell orders up here and price is here, I mean, it doesn't make sense keeping price here. Obviously, price needs to move higher to find these sell orders, which will then bring price lower to the next order block, which is down here, which is to buy. These orders are filled. Buyers enter the market. The liquidity to the upside is consumed by the bullish push higher. Price goes higher. It revisits this area here. And this is what we'll refer to, rather what you'll all know as resistance. We have some resistance here. We have support here. Price comes up, it bounces, it goes down, it bounces, it goes up to resistance, support, resistance, resistance. And so, I mean, if you consider this whole concept of support and resistance, every time price comes to an area and has a bounce, many people think, oh wow, that's a good area. Price comes up to it again. Wow, it's a really good area because price bounced 2 times. And if it happens 3 times or 4 times, many people are going to assume that, oh, this area has, historically speaking, been respected multiple times. This is a good thing. This means that I'm going to sell the next time price comes up to this area. But this is a bit of a fallacy, because if you consider the supply and demand trading model, you have pools of liquidity above price and you have pools of liquidity below price. So each time price comes up, we are filling these, we are consuming the liquidity at one of these areas. So assuming that we have 100 units of currency, this is a completely random number. If price comes up and we have people that are buying, and we have 50 buy orders that are filled when price comes up here, well then the 100 is going to be reduced to 50. And so next time price comes up to it and we have another 50, well, what does that do? Well, that simply completely removes all of the liquidity of this area. And what happens? What does this mean? Well, this means that if price should find bearish liquidity, it has to go to the next pocket of liquidity, which is going to be located above this one. This one is no longer available. It's completely gone. And so everything, everything readjusts. And so this is gone, so price has to go a little bit higher to find it. And eventually this will be depleted, first to 100, then to 50, and then it'll go. And when that happens, well, then this one is gone. Then price has to go higher. And so the whole concept of support and resistance is slightly dangerous, because you must understand that every time price does reach an area of supply, it becomes weaker and weaker and weaker each time. Okay, let's have a look at another piece of graphic here. Here. And so you can see here, assuming for a second that we have an order of 50,000 units to buy or sell. If you look at this and you think, okay, considering the liquidity available at each area, we have 10,000 here, 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 and here. So if someone comes in and buys 50,000 units of this instrument, of this security, what's going to happen? Well, this is going to happen. Price, the first 10,000 of this 50,000 block is going to consume this. And when that happens, in order to fill the remaining 40, it's going to have to go up to this one. Now we've filled 20, we need to fill 30. We go up to the next one, we filled 30, we need to fill 20. We filled 40, we need to fill 10. We filled our entire order. But what has happened in the meantime? Well, in the meantime, the price has slipped up like so. So this is slipped. I mean, this is ultimately what slippage is. Thin liquidity. So price consumes this and all of these levels. And so by the time this 50,000 unit order is filled, price has moved up from 25 to 45, so 20 pips. But on the downside, you can see we have much bigger pools of liquidity, well, bigger relative to the ones above. And so if 50,000 units comes down here to sell, the liquidity available at this area, which will be, let's say, an institution, they are going to be looking to buy 200,000. So when we come with our 50,000, the institution is going to buy it. And so that our order is simply going to be absorbed. So that'll reduce this to 150. Did price move? No, it didn't. So we have the thick side of the market, which is below price. In this example, the thin side is above price, okay? And so price will always, it has to move in the direction of the thinnest liquidity. Why? Because thinner liquidity is easily consumed. We could see in this example, price went up 20 pips in order to fill this one order here, but to the downside, price didn't move at all. And it'll require another person to sell for an additional 150,000 units to bring price down just 5 pips, in contrast to this 20 pip move with a relatively small order. And so that's pretty much the whole notion of what slippage ultimately is. So if we look at this here, we have a very similar representation where we have the big order and we have a bunch of small orders. These small orders here, and they correspond to these ones just over here above price, and this big one corresponds to those just below price. So this order here of 200,000 units is going to easily consume this, driving price. Push, rejection, price went a little bit deeper, it found unfilled orders, and then poof, then it popped up. This is lovely. This tells you that, wow, we have a lot of interest to buy at this area, sorry, from the high of the accumulation and low. Price came back, we challenged the lows once again, and then this is what carried price higher and away. We had this, price poked into it, we accumulated, we popped up, we moved sideways, we left, we moved above these highs. And this is important because while it's a little bit messy in here, I'm going to draw this off. We had this here, which was tested a bunch of times. And so we had support. You could also mark this off with the trend line, how we had market structure, which for me is just going to be a trend line or a channel. In this situation, it's a trend line. Price tested it, then price cut through it. What does that mean? Well, that means that we have an area of supply that caused price to break the structure of the market. So you ask yourself the question, what area of supply did that? Well, this one here did. This one here did it, right here. We're going to take, because it's a pin bar, we're going to take the whole body. And then we are going to look to the deepest pullback into that area. Where is that? It's right here. So we're going to mark it off like that, okay? Because price came back to this level and then it left. So this is the beginning of the sell zone. We're not going to be selling down here. We're only going to be selling from here and up. Price came up, we poked into it, and we left. We came through, we moved up. We had a accumulation in here. We tested the highs. We moved through it. Then you ask yourself the question, great, this is getting easy. Now we know that we have some demand. What area of demand consumed the supply? This one here did. So this is the next one that you're going to want to buy at. You put your order in here. The position size here, your stop is probably going to go below here, and this is where you buy. And currently price is reacting that. So on this time frame, the 1 hour chart, we have hourly demand driving price. And up here you can see we have a gray box. This is micro supply. So this is, we're going to go on the smaller time frame. This is telling us to go to the smaller time frames. And we have that lovely pattern as we've seen here as well. And this is where price is having a bit of a reaction. But price, this area of supply, has not accomplished anything. It hasn't consumed any opposing areas of supply, demand. And so this is not something that I would be looking to trade at. That said, we'll mark off the low of the box. We'll go down to the 5-minute chart and we'll see how big of a bounce we've had so far. I kind of lost my bearings there. I'll mark off the test. Okay, so this is where we are now. So we're just having a bit of a bounce at that level. And notice how accurate these are. Price had a test into that area. We poked into the beginning of the area of supply. which is, look at this, price comes down, it pulls back, it leaves. So the beginning of the sell zone starts at the highs of this pullback. Where did price come to? Exactly there, plus a little bit deeper. So we had a deeper push, and this is where we're having a bit of a pause for the time being. Then you look at the big swings. Wow, well, we had this, price moved down, we pulled back, and now price is going down. That tells us, I mean, this isn't necessarily supply here, but price did manage to retrace to this area and move away, taking out these lows, telling us that there's probably something that's going on here. I'd say this is likely, we had resistance, this area of demand popped up, price left, we'll just mark it off like that. It was tested once, this area of supply cut it out. So this is the next place that we would be looking to trade. This one here. And if we go to a smaller time frame, let's see if I can go to the minute, we can have a look inside and see what's going on inside that candle. You can see here that we have the candle that looks like this. So we have a 1 minute supply. This is really, really tiny, but look at the release from this area here. And this is the one that cut away from that 15-minute demand that we saw earlier. So we mark it off like this. You could take the wick, the lower the wick here, or you could take the body. But this is typically where price is going to have a bit of a bounce on its way up. And that's pretty much how it goes. It's very simple, actually, if you don't overcomplicate it. When you start attaching indicators to your chart and trying to turn it into some mad science, which it isn't, this is when things get very, very complicated, and this is when you get overwhelmed, and it shouldn't be like that. And just as to prove this fact, I've written an automated trading robot that is based on the engine of my supply and demand software, and it's trading on a VPS 24 hours a day based on the rules that I've just showed you. And I'm going to show you, I'll just show you very quickly, like the configuration of it. Let's see here. Yes, we'll do that. So here we are looking at, let's not focus too much in this, but what we need to focus on is this bit here, where we have risk to reward ratio, price and balance release period. These two are the most important configuration options in this robot. And what they do is they tell the robot how far price must travel and how little time price must get there in. And this is a good example of that. Price left this area of accumulation and it went, let's see, we have, let's say 8 pips, and it traveled 38 pips in 1, 2, 3, in 1.5 hours. So this is a very highly qualified area of supply according to my software. So it's telling us that, wow, we certainly want to be looking to sell up here. Price has come up here. We've had a little test and price came back. We had another test. And so the first one would have been interesting. This one would have been interesting. A trading robot that implements the same tools is just a really good way for confirmation, to ultimately confirm the theory that I'm running around thinking about all the time. Good. Well, I think we've reached the 13:39, so we're pretty close. We're about 6 minutes, 5 minutes until we have to finish this up. So I wondered if any of you have any questions that you want to ask. Then I think this would be a really good time to cover those. What do you think, FX Street? I think we're good on time still. So if any of you guys have any questions, it'd be super. We can maybe throw those out there now. I can see there are a handful of people in the room. I'll give you guys a minute to respond. And another thing, while I'm waiting for you guys to type in questions, notice that down here we have red. This dashboard is red. On this one, it's going to be green. And what does that mean? Well, that means that the interest rate swaps for this currency are going to pay returns if you are long the American dollar, Japanese yen. And that's because the American dollar has an interest rate of, I think it's 1.75, and the yen has minus 3/4. And so if you're holding these positions overnight, you're going to be paying swaps. And so it's just a good idea if you're trading on the longer time frames or with larger positions, that you're earning swaps as well. And so this is just a nice visual indication that I like to use to help me keep me on the right side of the swaps, because it can add up very much so indeed. Right. No one has any questions. What do you reckon, FX Street? Is the sound still good? I've gone awfully quiet. So I want to make sure everyone can hear me loud and clear. I want to make sure I haven't been rambling on for 45 minutes and no one's hearing a thing. Yeah. Good. Well, I'm not. Yes, excellent, Adam. Good, good, good. Is this stuff interesting? Is it oh, super. I'm super pleased to hear. Is it interesting? Is it surprising, or is it something that you guys are aware of? But either or. I hope it's something that you can use at least. It's a very simple way to view the market, or view anything really. Anything that's bought or sold. I mean, they play by the same rules, and I find that to be very fascinating. But I recommend that you mark off the 110.24 area on the dollar yen, and just watch what happens when price gets to that area next time. Note that it hasn't gotten entirely to it yet. We're still about 5 or so pips short, 2 or 3 pips short of the zone itself. We're just reacting on the wicks here, and so it's very interesting to see how price reacts. So mark that off and just have a watch when price gets up there, maybe later today. So I mean, the robot is trading these rules, and I've got the results here. It's running on a bunch of different counts and a bunch of different configurations. It's going to have a look here. And here, this is the past 312 trades. Short positions 1, 100%. The long positions 1, 100%. And we have, I mean, there's absolutely no drawdown whatsoever, because price is reacting at these areas to such a high degree. I mean, 312 a trade, that's a pretty decent sample size as well. If we have a look at another account statement here, we have slightly smaller number here, very small drawdown, and we have very high degree of accuracy here as well, which is just another example of the accuracy of this. It's phenomenal how well these areas hold. And look at that profit factor, 10,773. I mean, that's dizzying. It just seems wrong, because they say if you can have a profit factor over 1.5 or 2, I mean, then it's a thumbs up, then you're doing really, really well. And this strategy just works so well, which has been confirmed by this project, that it's just worth noting. We've got another account here, slightly fewer trades, very small drawdown as well, and very high, a very high number of positions, 1. Average profit trade 42, average loss trade 11, and so the parameters are nice. They are certainly showing us, rather painting the picture of a very stable and profitable trader. And I've got this running on some live accounts, quite a few live accounts as well. This is the past 144 trades. We have a very good accuracy once again. We have a very good profit factor, not as radical as what we've seen over here, but nonetheless. And this is 10% in about 3 weeks. We have another one, which is this one here, which is 1,325. This is a live account. Deposited $3,000 just under 4 weeks ago. And we are up $1,388, and that's under a month. So we'll do the math. What's that? 35, 36%. And look at the hit rate when we have almost a perfect hit rate. It's absolutely staggering. And so I think this is just a confirmation that that it's really worth investing effort in learning supply and demand, but also from a sell side, so you understand the liquidity distribution and how this distribution of liquidity is affecting price. And also keeping in mind that, price is indeed moving all over the place, as you can see if you look at a price chart, but it's moving because of unfilled orders and not the filled orders. Because, yes, price will go down, but it's not going to go down until we get up to around this area. So price is moving sideways. We have a balance in supply and demand. If we want to create an imbalance, price has to seek sellers. It has to find sellers, which it found when it came up here. Price went down. We poked down into something down here, so we moved into a pool of bullish liquidity here, and then price had a sharp push away. This looks like a very thin liquidity, so likely at the time of news, and into an area of demand. So you're going to see massive spikes like this, and our price is kind of meandering around since then. And notice, you have a crazy spike up, a crazy spike down. This is going all over the place. But keep in mind that even though you have mad news, figures out of one country throw one currency in one direction and the other in another, notice that price will almost always return to the base in order to figure out what it's going to do next. Price cannot go up and just keep going up. It will never happen. It simply can't happen. So price will come down. We'll see a big reaction. But in order for price to find its direction, to stabilize, to find parity, fair value, it has to come back to an area of the market where people are willing to buy and sell. And down here, we could see that people are looking to buy. And when this buying occurred, well, this ultimately drove price higher. So it's really, really, really fascinating. And this stuff keeps me awake at night as I ponder these things and improvements to the software and to the robot. So it's an incredibly exciting study, I think. So there's automated trading, but we also have discretionary trading, and I do both. I'm doing automated trading more as confirmation. It's a tool. It's input into my discretionary tools, which you can see here, and it's tremendous research. Up here you can see that we have a red rectangle. Red means daily, blue means 4 hour, white means hourly. And these boxes up here, you can see that these are dotted, they have a dotted edge. And this is because that they have been tested. And they were all tested just here. The low of the daily 4 hour and the 1 hour supply lined up very nicely. Price poked into those. And then we saw a very, very nice release. And this box had a solid border until price tested it. So now this has been violated. This is just telling you that it's likely that this area will not hold on future tests. So just a nice visual way to trade. And I think that making a trading robot that implements the same tools is just a really good way for confirmation, to ultimately confirm the theory that I'm running around thinking about all the time. Good. Well, I think we've reached the 13.